Markets react cautiously to Germany's new government, with key details at least 6 weeks away. The US economy is softening because of tariff uncertainty. China's central bank is using off-balance sheet tools to intervene in markets, and New Zealand's retail sector perks up. That's coming up in our 5 Things in 5 Minutes on Tuesday, February the 25th. And then, in today's bonus deep dive interview, ANZ's chief economist for India and Southeast Asia, Sanjay Mathur, has taken a closer look at the importance of household consumption in Asia's economies, especially as Trump's tariff headwinds start hitting their exports.
It is particularly important this year is because we won't see the same kind of tailwinds we did from other components of growth, such as exports. So in a period of high uncertainty around global trade, household consumption ideally should have played a pivotal role in driving the region's growth.
But first, in 5 and 5 with ANZ, global markets are mixed and cautious about reacting too much to Germany's change of government, to a centre-right one from a centre-left one, as markets expected. More on that shortly. The bigger news on markets overnight was another sign of weakening activity in the US economy, as doubts about Trump's tariffs set in. ANZ head of G3 Economics, Brian Martin, says a Dallas Fed survey of manufacturing out overnight was much weaker than expected.
The important thing about this regional survey is that it has followed very quickly on the heels of the flash February PMI numbers, particularly for the services sector, which showed that services activity for this month has fallen back below 50. And then when you add to that the University of Michigan consumer confidence data, which have weakened, and both current conditions and expectations within that are weakening, there's an accumulation of data now indicating that tariff uncertainty in the US is beginning to weigh on business sentiment and consumer sentiment.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was flat, while the Eurostoxx 300 index closed basically unchanged. The US 10-year yield fell another 1 basis point to 4.40%. The US dollar index was also flat, the Aussie dollar up 0.1% at 63.59 US cents, while the Kiwi was also up 0.1% at 57.44 US cents. Number 2. Germany's election results may not have moved markets, but they are important, with the potential for the new centre-right government to unleash the debt brake, especially on defence spending. Here's Brian again on what to watch for in the next couple of months as the makeup of the coalition government and its policies are hammered out.
The 3 areas that there will be a lot of talk about are defence, clearly what's going on in Europe at the moment, with immigration. The CDU-CSU very much campaigned on clamping down on undocumented immigration into Germany, and the economy. For the economy, the debt brake, that is the fiscal rules in Germany. Will they be eased or will they not be eased? At the moment, the debt brake means that the budget deficit in Germany on a cyclically adjusted basis shouldn't exceed 0.35% of GDP. Now, if they want to change that, a 2/3 majority in the parliament is needed. The CDU and CSU won't have a 2/3 majority. So there's a lot of speculation about how could they ease fiscal policy. It is going to take some time.
Number 3. The euro initially rose on the election results, but has slipped back to $1.04.72 US cents as of 4 a.m. Those tariff concerns remain unresolved, says Brian.
The real thing that's affecting the currency markets at the moment is concerns about tariffs and US tariffs on Europe and how they will affect economic activity within the single currency bloc.
Number 4. In New Zealand, retail trade volumes rose a stronger than expected 0.9% in the December quarter, suggesting a recovery in the consumer economy has finally begun, says ANZ New Zealand economist Henry Russell.
This release confirms that a recovery in consumer demand is underway, with strong growth evident across the more discretionary spending categories, things like spending on electronics at department stores, recreational goods and accommodation and hospitality. Nonetheless, despite the upward surprise today, retail sales volumes remain very weak in level terms, and they're still over 9% below their previous peak back in 2021.
Number 5. The People's Bank of China is increasingly using a lot of off-balance sheet tools to intervene quietly and tangentially in stock and bond markets, says ANZ senior China strategist Zhao Pengxing. But he says that could prove problematic if the central bank really wants to use its balance sheet to stimulate the economy through QE or quantitative easing.
It's too early to see the QE by the PBOC. At this moment, I think the PBOC will try to explore these off-balance sheet tools at first until they find that they have to expand the balance sheet. So that I expect the People's Bank intervention to the stock market and the bond market will continue to be measured.
Xiaopeng there. Now, on our bonus deep dive interview, ANZ's chief economist for India and Southeast Asia, Sanjay Mathur, has taken a closer look at the importance of household consumption in Asia's economies, especially in the face of tariff headwinds to their exports.
The most important thing to bear in mind is that household consumption accounts for at least half of GDP. In the region, it goes as much as 72% in the Philippines. And why it is particularly important this year is because we won't see the same kind of tailwinds we did from other components of growth, such as exports. So in a period of high uncertainty around global trade, household consumption ideally should have played a pivotal role in driving the region's growth.
Yeah, because we've had those shocks through COVID and afterwards. Have we got back to normal?
On the face of it, it would appear we have gotten back to normal. But if you sort of look at the details, one of the things you're starting to see is that the incremental consumption as a share of your incremental income, that is going down in almost all economies. And the second change is that even though consumption may appear to have normalized, households are not really spending a lot in terms of the discretionary side of things, such as autos, consumer durables, etc. They've certainly backtracked from that.
And when you look at why this might have happened, is there any evidence to point to reasons?
Yes, it's ironic that all this is happening when the region appears to be at full employment. But two things seem to have happened. One is if you look at the kind of new jobs that are being created, they're fairly low-paying jobs in the food and accommodation industry. And the second change is that there is also a deterioration in savings rates in the region. It's very different from what we see in advanced countries where we saw that basically governments had given a lot of cash assistance to people during the pandemic. We did not see that. If anything, we've seen a big rise in income inequality, and clearly, the lower income groups have suffered a lot.
Yeah, and it looks like incomes from wages aren't necessarily particularly robust either. Could you tell us what you're seeing in terms of wages and wage growth?
So that becomes a new headwind this year, that even though there are no signs that unemployment rates are going up, but certainly wage growth has started to moderate quite a bit across the region. So if you have weak exports, incomes in the tradable sectors are not going up very much. As households get exhausted in terms of their savings, that by itself has an impact on wage growth. So across the board, you've seen that wage growth has slowed down considerably, and in some ways that becomes an additional headwind to consumption this year.
And therefore, what is the role of fiscal and monetary policy in addressing some of this weakness?
Ideally, it should have been aggressively supportive, or it should have been designed to be aggressively supportive. But our estimates of net welfare payments, that is, the extent of support handed out by the government relative to, say, new tax payments, that's going to be fairly mild at around 0.2% of GDP. The only exception on the strong side is Thailand, but we also have economies like the Philippines where it's going to be completely flat. So that's not going to do very much. The second thing is that even though we do expect monetary policy to be eased and rates to come down, if we just look at the extent of rate cuts that we have penciled in, particularly when you adjust them for inflation, then it leaves you with real rates that are significantly higher in relation to the state of consumption.
Asian consumers will be one of the supporters and drivers of economic growth in the region if we see a pullback in exports or export receipts because of some sort of slowdown of trade linked to changes in tariffs. So just tell us how important, therefore, that household consumption is in that context.
What was going to be extremely important, relying on domestic demand when exports are weak, is certainly a very, very good counter-cyclical development. But in this case, what we are going to see is a lackluster household, lackluster exports, and weak investment that is also not supported very strongly by policy. So net-net, it all points to slower growth.
Sanjay Mathur there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, February the 25th. Catch you tomorrow with a preview of Australia's partial inflation indicators for January. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.